Hi everyone, and welcome back to FANG Friday. This is Ross Healy, the chairman of Strategic Analysis Corporation and a senior portfolio manager at McNichol & Associates Asset Management. Well, while our approach is very helpful for investing in portfolio management, our system can also be used for trading, and so we have developed an addendum to our service which we call breakpoint trading, which our more active clients use as an adjunct to their own long-term investment program. We publish these as trading buys only, looking for fairly quick gains of 15 to 25% roughly, and then out. Last year, for instance, we provided about 60 such stocks, which returned on average about 18%. We are considering offering this as a standalone service to any of you who might be interested. Now, we do screen every stock for balance sheet quality, upside potential, and risk. So every stock among the 4,000 that we follow do not automatically qualify for inclusion in the service, as I will show you in a moment. When I look at the FANG today, I will try to further illustrate what this service looks like. Although I do have to point out that the FANGs do not represent low-risk value, nevertheless, from time to time, one or more of them do offer sound and sensible opportunities for a reasonable trade. Before looking at the FANGs this week, however, allow me to make an important observation. We've had a fairly poor day in the market as of the close of today, with the market falling at its maximum of about 1.5%. Curiously, this has not happened in this bull market going back for a long way, and it's the first decline of more than 1% in over 75 trading days. Given how strong the market has been today, and investors are feeling quite comfortable that there's nothing but blue skies ahead, it may be a good idea to be a little more careful for the next few days. Okay, let's start off, and I'm going to start off actually with one of our trading ideas, Canadian Natural Resources, and I want to illustrate what I'm talking about. First of all, when we look at where we recommended the stock, it was right at its normal price. That's a book value of 1. And of course, I can go back. I can go back for 35 years in CNQ, and I can see when I do that a book value of 1 actually represents an extremely low valuation. So we kind of had history on our side. Secondly, we had very good upside potential. See, here's the fair market value line there. So at the bottom, the upside potential represented nearly 100%. That is to say, it is at its growth price of twice book. Thirdly, if we look over here at the stability ratio, that is to say, the balance sheet quality, we see that it is very, very good. In other words, here's a company that had 3 strikes not against it, but 3 strikes for it. And so we recommended it. Let's compare this with the stock that actually came up right today from one of our clients, United Rentals, Inc. And I want to compare the two very much. So one of our clients actually found this because we have a screening process that our clients use, and he noted that the stock had broken out over its mid-growth price. That's 2.5 times book value. Had set back to the mid-growth price and thought, well, maybe this is a good time to buy the stock. And I mean, look at the fair market value. It's 117% above the current price. So what's not to like? Well, I tell you, looking at this chart, and I hope that you will see it in a moment, I'll tell you what's not to like about this stock. First of all, yes, the stock has broken out, but look at it has broken out in the last 2 years once, twice, 3 times before, and every time it set back. In other words, it didn't hold. Where it did hold was when it got to its growth price. That's 2 times book value. And look at there, once, twice, 3 times it bounced off there and had a lovely move of 25% higher. The other thing that really concerns me, however, about United Rentals is the quality of the balance sheet. Look at the stability ratio of 0.53. That is very weak into our way of looking. So this is not the kind of company that I would consider to be a quality addition to one's portfolio. Anyway, on to the FANGs. Let's start with Amazon, and we're going to take a longer look at Amazon because I want to go back about 1.5 years to where we did actually recommend Amazon as a high-risk trade, but we thought as quite a reasonable trade when the stock broke out over its HB4. That's about 16 times its book value and set back there. This was in that correction in early 2018. Curiously enough, 2 other FANGs did exactly the same thing. That is, they broke out and set back. So we had 3 of the 4 principal FANGs actually lined up as buys. And sure enough, we had a nice move in that stock. Of late, however, you note, and I've been talking about this now for some time, Amazon has broken down below its HB3, and it just hasn't been able to gain the strength to pull back up over the line and give us an actual buy signal using SVA metrics. So we have not touched this company since that time. Netflix, on the other hand, also came up to a breakpoint, also HB3, by the way, broke out, pulled back, as we would expect technically, and has tended to move on further since that time. And indeed today, even though it was a very poor day, generally speaking, Netflix actually has had a fairly good move today. Facebook, well, Facebook doesn't kind of really seem to want to gain a head of steam, does it? It kind of clings like cloth to its MSG price. That's 5.5 times book value. It sort of takes a little run and then pulls back and takes a run. Now maybe this is more sincere and maybe it wants to go higher, but my overall feeling from Netflix is it really does not want to give you very much. We can compare that with Alphabet, and look at Alphabet. At its low super growth price, that's 4.5 times its book value. It banged up against that and banged up against it, and finally has broken out. Maybe it can get as high as its MSG price, but which is 5.5 times book value. But as I have showed you before in this, as far as the trading of Alphabet is concerned, when it gets about halfway, it appears to run out of gas. So while we've got a promising signal, and I wouldn't necessarily be wanting to sell the company if I'd bought it on the breakout, nonetheless, I do have to warn you that history is sort of against you. NVIDIA, well, of all the FANG stocks, at the bottom in 2018, in December 2018, NVIDIA gave us the absolute clearest buy signal. It had fallen, look at that, 4 breakpoints, 1, 2, 3, 4 breakpoints. and hit bottom at its bubble price. And I've told you before, I'll say it again, the bubble price is a very, very significant price in stock analysis, SVA stock analysis. And the company has had a very nice bounce ever since. Now, more currently, the stock has been banging up against its HB2 price. That is, that's about 12 times its book value. So far, it does not appear to want to break out, even though you can see the fair market value has kind of turned. Nonetheless, it's, well, I hate to say it, but it's 53% lower than the current price as of today. However, look at these days, who cares about fundamentals? That appears to be the general tenor of the times. Does it have momentum? Buy it. In that case, then, maybe this company can break out and move higher. But it has been struggling against the HB2 breakpoint now for some time, even as the stock market has moved higher and higher. Apple, well, there's Apple. I guess the last time that it actually made a breakout, you can see back here in September of 2019, and it's been moving high steadily ever since. It remains suspect value from our point of view if we look at the history of the company, but we can't argue with the fact that the stock has performed very, very well. And finally, Microsoft. Well, Microsoft is an interesting case because it got up to its HB1, that's about roughly 10 times book value, and it struggled and struggled and struggled and struggled, trying to break out, and it couldn't for the longest time, and that's because the HB1, looking back, is a very, very significant breakpoint for this stock. More recently, it has now broken out. It broke out and had a little pullback and has been moving higher. Maybe it can move on to its HB2 price, that's 12 times book value. I don't know. The fair market value is, well, it's minus 43% lower than the current price. But certainly its stability ratio, that is to say the quality of its balance sheet, is excellent. And if this market keeps on going, then perhaps this company can keep on going with it. If you had bought it on the breakout, good for you. I don't think I would be buying it right here. As I said in my introductory remarks, there are some concerns about the short-term outlook for the market as far as we're concerned, so we would be fairly cautious at the present time. Anyway, that's a look at the FANGs for this week. This is to remind you that I am Ross Healy, the chairman of Strategic Analysis Corporation and a senior portfolio manager at McNichol & Associates Asset Management, reminding you that nothing, including investing, is difficult if you have the right tools. And as I showed you today, when we looked at a couple of hard examples, I hope you have some glimmering of what I am talking about. Anyway, have a good week. See you next Friday.